So in this video, we're going to talk about how to enter your trades, different techniques that you can use when entering a trade or before you enter a trade after you've went through the identification phase, meaning the identify, predict, decide, execute phase. And we're also going to talk about the combined technical score where you're kind of rating or grading that trade because you only want to take the best of the best, meaning the ones with the highest score. Also meaning the trades with the highest probability. You want to take the best of the best. You want to take the good ones and you want to leave the bad ones alone. Now, in combined technical scoring, that's adjustable. That is also something that can be done according to the trader's liking, depending on how passive or aggressive the trader is. But let's just jump right into it. So here you see a completed Gartley pattern, a bearish Gartley pattern, which has filled. Okay, it's completed, basically. It's completed. Let's just walk through the rules of engagement real quick, as we've been doing in most of our videos. And of course, identifying this impulse here, and then, which gave it the X to A leg, and then the correction for the valid B leg. It's at 72%. I hope that's not too small to see. I'll pump it up for the sake of this video. I'll make it a little larger. Okay. So identifying that, but it would have been being tracked as it was, as it was developing. And you go look at the video yesterday that I made. The market simply wanted to make this Gartley pattern, and it was going to make it regardless. It was going to happen. So validating, identifying the impulse X to A, validating the B leg, making sure that it at least hit the 618 retracement of X to A. It's at 72%. Validating that C leg is valid from the A to B retracement, needing to be a 618 or a 61.8 retracement. It's 688. That's good. So valid B, valid C, and then just wanting to know where D is. And in the Gartley pattern, the D completion is a 127 extension of A to B. So I like when I do this because every time I do a video, I get to teach this again. All right. And for those who haven't heard me talk about it, or they can go validate it for themselves, the founder of this pattern, H.M. Gartley, said that this pattern has a 70% success rate, and he had tested that over 30 years. So that's what makes this so special. Okay. But again, I want the focus of this video to be entering now that you've identified, because remember, there's the identify, predict, decide, execute. So predict, this was going to be a Gartley pattern, and that would have been back here already projecting this D completion. Okay. And deciding, okay, everything is right. Okay. And then executing, that's the main part. So that's what's going to take us into the CTS part, the combined technical scoring. Does it rate high enough for us to test? We know it's filled. We'll come back and we'll talk about the entries in a moment, how to enter, because there's a couple of different ways to enter. But the first thing that you want to know is, do you have bearish divergence? Okay, that's first. I want to see something that's telling me that even though it looks like price action was going up and that this was a higher high than this B leg, that D was higher than B, actually, this is showing bearish divergence. And two, do you see it being overbought in any case in this bearish example here? Okay. And it doesn't need to be overbought at your entry. This one happens to be, which is better. You got an extreme overbought here that begins your divergence. And even at your entry, it's still above 80. Okay. We use an 80-20 overbought, oversold instead of the 70-30 default out of box RSI settings, because a 80-20 is a lot more extreme. Okay. So now we've covered divergence real quick and what that means. And the speed of the price action, showing you that it's slowing down. See, now the stuff is becoming visual. Okay. And that it's filled. We got our overbought, oversold, and our divergence. So we hit that. So when you talk about combined technical score, you can give yourself a point for being overbought or oversold. You can give yourself another point for the divergence. That's 2 points. You're going to give yourself maybe 2 points or 3 points for being a Gartley pattern. You're at 5. Then you can continue to do other things like lower time frame confirmation or higher time frame confirmation. So I'm going to go to higher time frame confirmation with the 4 hour. We don't get what we would like to have on the higher time frame confirmation. It'd be great if this was also overbought with divergence. That would help. That would give us more points. But so far we're at a 5. But for the sake of this video, we're going to focus on the 1 hour, which is our trading time frame. In this case, you got your trading time frame, and then you got your higher time frame confirmation and lower time frame confirmation. Since I really started this off the 4 hour and now I'm on the 1, I'm not going to jump down. I'm not going to drop down to the 15 because things probably won't make a lot of sense. I don't need that much. That looks pretty good with this double top in here. You could add that to this double top in here. You could add that to your combined technical score and say, hey, even when I dropped on the 15, there was a retest, a failed retest. So you would basically be at like a 6. Okay. Now that we got that stuff out the way. Okay. Entering. Okay. Let's talk about the entry. The first one that I want to talk about. Okay. Actually, this is what I'm going to do. I'm going to talk about the different levels of aggressive versus passive. An aggressive trader might want to say, if that fails, I'm taking it and just enter at market. That's just a market entry. That failed, I'm going to take it and then I'm going to find out where to place my stops at. I'm not going to get into stops yet on how this trade would get built out. But an aggressive trader will see when this bar comes up, he's going to hit sell in this case. This is euro dollar. He's going to put in his lot size and hopefully he's going to put his stops and targets in and he's in. Okay. The next entry is the next bar market entry. Now this one is a little less passive than just a straight up market entry when the Gartley is filled. Next bar market technique. Really? Or entry. And then the next bar market, what he's going to do, the reason it's a little bit less is because he's going to let this close. He's going to let this close. And then he's entering on the second candle. Okay. All right. That's the second way. Next bar. When this one closes, I'm going. Okay. Because there's a couple different, I think there's going to be 4 in here I'm going to talk about. The first one, very aggressive. As soon as it fails, I don't care what's happening. I'm trading it. The second, I'm going to let that close because I don't know where it's going to. I'm going to at least let it close and then I'm going to go. The third one is to allow a candle to close in your bias after. So you got your filler, you got your red one. This would have worked for allowing one to close in your bias. But the next one would have been to let this one close red. So this is building more confidence. This is allowing it to say, I'm good on this. And you're watching this live too. A lot of people have asked me to do this. Watching this live. Let that third one close and then go. But at that point, you're kind of tapping in to your profit, and that's why the aggressive trader wants his entry price to be up here, because if he wins, he is going to get more profit. He's going to make more money than the person who lets this red one close. Okay. So I just wanted to talk about that real quick. So you got your aggressive entry where the trader it's filled, I'm going. You got the next technique, next bar market, I'm going to let that close and go. Then you got a more passive one that's going to say, hey, I need more. You need to really show me that you're going to turn over, react, and win for me, which would be letting this one close. But of course, like I said, wherever that closes, that means he's gonna be leaving some money on the table. But he does have a higher probability to win. Okay, the last guy. The other guy, the last one, number 4, he's just as aggressive as number 1, because what he would have done is set a limit order, meaning create new order. Just walk through this real quick. And limit order, a sell limit order, and he would have put a sell limit order at 105.062. he would have put a limit order. See how the order popped up at whatever he was going to trade there. And of course, you want to put your stops and targets in there. But this video is not about stops and targets, so I'm not going to do that. I wanted to talk about entry. And I do want to talk about constructing and building the whole trade. I kind of might as well, because we talked about that entry. So it would be kind of disingenuous for me to leave that out. But we'll do what we did on the stop loss video that's out there called Where Do I Set My Stop Loss? So, of course, we're going to use an ATR based stop loss. We have our entry. We know that we either had went when it filled, or we waited for the first candle to close. We waited for the candle to close, then we went, or we're waiting for that. The third one. We know all those things already. I'm going to take this off. We don't need them anymore. So let's talk about protecting the capital and putting the stop in place for it. Remember, per the video that I did yesterday on where do I place my stops, okay, you're just going to line off X, because the ATR is going to be based off X, because your stops need to be above X. That is 105,332. Then grab this data window here and go get your ATR indicator, average true range indicator, put that on. Then simply hover over to that area over there. Let me move this out of our way to make sure we're good. Hover over there, get the ATR of that X right there, and it's 00178. Hope I don't forget that. And that would have been our lined off X. Our price at X is 105,332. Actually, this is what I'm going to do. I'm going to copy it, make it easier. $105,332 plus, because it's going above, plus the ATR. Anybody remember what it was? 00178. 0.00178. It's going to tell us to go to 105. I'll just actually copy it off again and put it on the line. Put it at the price, adding the ATR to that price. And it's going to tell us that that's where our stop loss should be, up there. I'm going to remove the ATR because things are getting too clunky in the data window. And I'm going to put our X back where it was, over here. So it's a little tight, but it's right where it should be. So now the trader would have his entry right there, because he either chose one. He was either aggressive, and as soon as it filled, he just fired off and went for it. He made sure that he had a high enough combined technical score. He went ahead and he used his filters. He did this thing the right way. Okay, so he determined his entry. He either flew off the market as soon as it filled. He either let the candle close, or he had set a limit order, whatever. And then he came around, he's using an ATR based stop right there, right? Because he got the price of X, and then he got the ATR of that candle, and that's where it was. It was 1,510. So looking at this all together with him entering right there at the 127 extension entry, and knowing that he can probably come down to about here, right, for his two targets. This is Gartley. There's no telling what can happen on this. There was another pattern on here. The previous pattern was just as devastating. But anyway, if I were to use Fibonacci to look at targets, I would measure the Fibonacci retracement of A to D. And it's basically a two target setup, with target one being a 382 retracement of A to D, and target 2 being a 618 retracement, which is what you see how we have the trade set up. So that's how the trade would be built out altogether. And while we're here, let's just talk some trade psychology. You've done all the work. Okay, do not get in the way of your hard work. Let the trade work. You got a good stop in place. You're either going to win or you're going to lose. If you win, you're going to win at a 3 to 8 risk versus reward. It doesn't get any better than that. And if you lose, you protected yourself. Okay. So I just wanted to add that little piece that after you've done all that work, don't blow it. Trade management is going to be one of the hardest things for you to figure out and deal with and work through in these markets. Not taking your profits too soon. Trade sabotaging. Okay? You've done the work. Trust yourself. Allow the trade to win. Let your winners win and let your losers lose. Okay? So I hope that there was some value in this. I hope that you understand those 3 or 4 different entry techniques. Entering as soon as your pattern is filled, letting that candle that filled your pattern close and then entering, allowing a candle to close in your bias, which might be a couple of candles later, or just setting a limit order and saying, hey, you know what, when price hits this, basically we're going to use the broker's automation or the platform's automation and let it put us in the trade, put the stops and targets in there and be done with it and live with it and be okay with the work that you've done. Okay. So I hope there was some value in this. Like the video, share the video. For anyone who has had questions in this area, subscribe to the channel. Could really use the support as I continue to build out this content. As far as I'm concerned, nobody is doing content like this. Nobody is breaking down and teaching the way that I do. There might be some things out there, but I think you should come get it here. So like, subscribe, share, leave a comment. I do try to reply to each and every comment, and I appreciate you guys. Be safe in the market. Take care of yourselves, and I'll see you on the next video.